Mortgages, they're part of everyone's life, not just in Canada, all around the world. I think most of you know what a mortgage is, but we're here today to look a little bit deeper into factors that go into choosing a mortgage and different types of mortgages. Good morning. Welcome to Canada Now. My name is Naresh. This is my buddy Paul, and we're here to go over every type of mortgage.
Yeah, go over a few mortgages anyway.
That's one of the big things in life, right? Mortgage.
Yeah, and like not everyone has one. They're, you've paid it off. If you're younger and paid it off, or you're older now and have paid it off. But that's good. Congratulations to you.
Yes.
The banks may try to come out and see if you want a reverse mortgage. Well, we don't want those.
No, stay away from those. We can go over it quickly, but stay away from those. But this is more for people who are just starting out, maybe buying a first house, because people buying a second or third house may have already gone through some of this. This will really interest people who are buying their first home. Am I right?
Yeah. So it's just when choosing a mortgage, you want to consider a few things. So the interest rate, what's good, the loan term, how much you're going to put down payment, the mortgage type, which we'll talk a bit about, the amortization period.
Say that 5 times fast.
So, 5, 30, depending on that period.
Yeah.
The prepayment options you want, if you want to pay more down, any additional costs, the financial stability that you have, and the lender, what you're borrowing, because there's so much out there, right? You have the banks, you got brokers. There's so much out there, a lot of advertising, so can be overwhelming.
Yes.
Yep.
Just stay away from the mafia. Lenders.
Yeah, and there's private
mortgages too,
private
right?
mortgages, which are legit. It's just they could be a little bit more expensive. It's if you can't get a mortgage from somebody else, you go to a private lender, and you're probably going to pay a bit more.
Higher interest rate. So let's start. What should we start with first?
Fixed rate mortgage, probably.
Fixed rate mortgage.
Okay. This is how it sounds. It's a fixed rate over a period of time.
Yep.
You have predictable payments, long-term security. It's just so... most they go up to you're going to be a fixed mortgage for 5 years. Okay, so but then you'll be doing some renewal. Fixed rates normally more expensive than normal, but
so when is it better to get a fixed rate mortgage when the interest rates are low? I'm presuming then, right?
Yeah, that would make sense for sure, because then you're fixing it at that low for whatever you're setting it into. If you're doing 5, you could do 7, but it's going to be a bit more because the banks. So. Yeah, if you pick a 2.4% mortgage, you might want to lock that in fixed for 5 years or whatever, if that's what they're offering. It's not really around right now,
no,
as you can tell. But the interest rates have been coming down. They're probably going to come down a bit more.
Yeah, I think this week they were saying possibly come down a little bit more, and due to the external factors that are happening right now.
Yeah, and just you could pick the term, but then the amortization period is. If you pick 10 years as an amortization, your payment's going to be a little bit higher. If you pick the 30-year amortization, your payments will be a little bit less.
Now,
so it goes off the...
Just for our viewers who might not know, who've never bought a house, what's an amortization?
Well, it's just the duration of your...
the entire mortgage?
Yeah, the entire mortgage that you're going to take out. So after the 5-year comes... then you reset.
You renew it.
Yeah, you renew it. So, and there's different, you can do a weekly mortgage, bi-weekly, accelerated bi-weekly, or monthly. But the shorter if you do an accelerated weekly, you're adding those extra payments.
Right.
2 extra payments a year. So you're going to bring down your mortgage a little bit quicker.
So the name of the game always, with any of the mortgages that we discussed today, the name of the game is going to how fast you can pay it off. I think most people want to get, because it's a major part of their life, mortgage, and they want to be able to pay it off quickly, get it out of the way, that way you own your home.
You want to try, and I find it tough in Canada, the home prices are crazy, and
exorbitant.
mortgages are so high. it is a feat to pay it off.
Yeah.
Some places in the States where you can buy $150,000 house, or
Yeah, you can.
$250,000. Your mortgage is you could do a 15-year fix down there.
Yeah.
And have it paid off. But here, yes, it's a little more difficult.
Yeah.
But yeah, the goal is eventually you want to try to pay off your mortgage before retirement.
Let's say you buy a first house at 25 and it's 30-year mortgage. And
You should pay it off.
By.
But some people use their mortgage and want to buy stuff.
A boat.
Yes.
Big truck.
And then, put that towards their mortgage.
Yeah. They add that onto the mortgage, right?
They do a HELOC, home equity line of credit. So you can borrow from your house.
Yeah.
You can do it in the right way, but just don't buy stuff, right? You can do some investment stuff if you want, but you want to try to stick and pay down the mortgage.
Yeah.
And not saying you can't have a mortgage in retirement. You're gonna have more payments. So as long as you like I said, as long as you budget everything in there.
Yeah. So that was fixed rate mortgage. The interest rate remains the same for the entire term.
Yeah.
Provides stability in monthly payments, making it ideal for those who prefer predictability.
Yeah.
The next one is variable rate mortgage.
Yeah, variable rate, I guess. So this one is how it sounds, variable rate. So say you're paying 2.4, but the interest rates go up, then your mortgage will go up. So the only difficult part with this one, it can be, is it just, actually this is a good example, it just happened, right? So you had a variable rate mortgage at 2%, and then this last few years happened, it's kept going up and up and up. So you're now paying 6%.
Yeah.
So that's the downside of that, because you're going to pay more.
So payments may stay the same, but the portion going towards principal versus interest can change.
Right.
Because that's what it is, right?
So you're not putting as much towards your principal, you're putting more towards the interest.
Interest payments.
Yeah.
Yeah.
And just renewing your mortgage, this is how the banks, right? So you're renewing your mortgage, they're resetting all that. So you're going to pay more. So it's best to try to pay down the mortgage as best you can. Because if you keep renewing it every 5 years, it's just gonna.
Is it with variable rate mortgage? Are you a person who might be thinking, okay, I can try and look long term? Are the interest rates going to come down? Are the interest rates going to stay? So you're trying to guess a little bit. Is that might be it?
Yeah. So when you do I always say if it's less than 1% of the fixed, then it's probably a good idea to do variable. But yeah, you also got to see what's happening too. And this is why you want to meet with someone to say, is variable rate going to be for me? It's not for everybody. But you can do a variable rate that you lock it in. So all of a sudden, you feel like they're going to go up, then you can lock that.
Then you can lock that
for the remainder of your term.
Okay.
You can do that.
Yeah.
There's options to do that. So variable rate, it can be good if it's going to go down. But if it's a low variable rate, you probably want to do a lock-in.
Of course,
You want to do a variable rate. If you're at 5% right now and you think they're going to go down, variable rate mortgage is probably a good option because if the interest rates come down, yours going to go down. And then all of a sudden you can lock it in.
Lock it in right there. Yeah.
Variable rate, if it's a little bit higher, is probably a good option that it's going to come down. So the disadvantages of it though is different payments every time, right? If you're not
some people
into
like
a budget,
predictability for their budgets, as Paul and I have spoken in the past. If you have, you should know your budget. You should know what your expenses are. You should know what your income coming in is, and what you have left, and that should be able to help you make a decision as to what kind of house you can buy, condo, house, townhouse, and then from there, what kind of mortgage you will have.
Right.
So
because if you don't know if you have a up and down income, you may not want that variable, so you may want to try to stick to fixed. And keep, then what you're paying. If you can budget a variable and you don't mind it going up and down, and it doesn't normally go up down, up, down. It's
yeah.
like it's creeping up, and then all of
Or
a sudden it'll creep
start
down.
creeping back down. Yeah,
It's not going to go dot 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 like the
yeah,
market.
yeah. No, you're right. Absolutely.
Yeah.
So we got fixed rate mortgage, we got variable rate mortgage, and next one is open mortgage.
Open and closed mortgages.
Yeah.
Choosing between it depends on financial flexibility. It just allows you to pay off your mortgage in full, make large sum payments without penalty. So, if you get bonuses at work or whatever,
Yeah.
you might want to use that bonus to pay down your mortgage, right? So, if it's an open mortgage, it allows you to do that.
So what you're saying is with fixed and variable rate, you may not have that same flexibility.
You just got to check your terms. Yeah, you can. If you have a variable rate, you could pay a certain amount. If it's a closed variable, open variable, you can put money down. You can put up, it'll be a percentage, 10% a year
right.
in lump sum. Or
Right.
you can do double up payments.
Okay.
So every mortgage will have something that you can, you just got to look at your terms. That's all.
But with open mortgage, can you put up as much as you want then? Is that
Yeah,
what
you
it
can
is?
pay off your mortgage in full.
If you want.
Yeah.
Let's say you happen to win get some inheritance, win a small lottery or something.
Yeah, pay
it off,
Yeah,
right?
you
No,
can
without
pay it off.
without any penalties.
Yeah, and then the closed opposite to that is like it limits how much you can pay off without penalties. So,
Right.
And again, it just could be up to 10 to 20% annually. So sometimes the interest rates open mortgages are a little bit lower. So that all depends because the flexibility. The banks, their interest rates. Because if you can pay it off, then
Yeah.
they're
They're going to charge you less or more?
no more.
More.
No,
So
they'll
they're
probably
higher.
want to try you higher. And
Yeah,
a
yeah.
closed mortgage, you can't pay it off. So at least they know they have you for a little longer.
They're going to make money off of you.
Right.
Yeah, so a little bit low. Banks are always about making money. You always
Right.
should be sitting down with a mortgage specialist, right? When you
Mortgage specialists, some financial advisors are familiar
mortgage
with mortgages,
experts?
or they know it. But sit down. Because everybody's different. Everybody doesn't have the same mold. So
Right.
you want to sit and make sure that this is right for you. You're going to pick, what property you have.
Yeah.
And then say, hey, what are we going to do for mortgage?
What your
What
your income is, what your expenses are, and what you can afford, right?
Yeah.
So convertible mortgage.
Yeah. So it's just it's an option that's a short-term mortgage and later convert it to a longer-term mortgage if you want.
Right.
Have shorter terms such as 6 months or something.
Right.
Okay, and then either a fixed or variable rate interest rate. There's advantages. There's no penalties.
Right.
It's adaptable. Drawbacks are a little bit higher interest rates. It's a temporary solution.
So basically, what you're saying is a convertible mortgage. It can start out as an open or variable mortgage, but can be converted to a fixed rate mortgage without penalties.
Yes. Yeah,
Okay.
Yeah. Okay.
All right. Which one is next, Paul? Hybrid or combination mortgage? That's basically.
They're just getting into the weeds there, but
Yeah.
the majority are
home equity line of credit. You mentioned that just a couple of minutes ago.
Yeah, HELOC. So basically, you could take your mortgage,
Yeah.
and what they'll do is they'll allow you to give you a home line of credit to whatever.
Right.
Let's say your house is worth $1 million.
Yeah.
You have a mortgage of $200,000. They will loan up. Could have a home line of credit of $500,000.
Yeah.
You have access to.
Right.
So be careful.
Yeah, because you're using your home's equity.
Yes, home's equity, but
Right.
they are going to charge interest on that.
Yeah.
So that's normally higher. So right now
So it's higher on that part or
on
the
that
entire
part.
on
No,
that
on
part?
that part.
On that part.
So
Okay.
you set your mortgage part,
Right.
variable or whatever that rate is, 3%, but then you borrow from that home line equity. It's
Right.
definitely a different interest rate, and it's
Oh,
all
I see.
broken down for you.
Yeah.
You just got to understand that.
Yeah.
So, some people borrow that. That's where you don't want to buy stuff.
Yes.
It isn't. It's
Renovation is investments or emergency fund needed for something.
If you
But a
want to
lot
do
of
that, that's
times-
why I like to have the emergency fund separate. But
Yeah, you should have your emergency
You
fund
can use
separate.
it, but if you're going to invest in something, well, whatever the interest rate is, make sure that your investment's going to be better than that.
Yeah,
That's
because
all.
you're saying some people. I've heard of some people borrowing money against their house or whatever, and then investing. You got to be very careful with that, right?
Yeah. That's leveraging your. That's leveraging. So you don't want to get too, because you could say you take out 300,000.
Yeah.
I want to put Bitcoin. Well,
Tomorrow Bitcoin
goes
crashes.
down, and then you're like, well, you still got to
pay that off. Yeah,
and then you're at a certain high interest rate, right?
Yeah,
So
yeah.
you really got to be careful. It is good to invest if you want to use your home equity, but that's HELOC. A lot of people offer them.
So HELOC, this home equity line of credit, you already have a mortgage set up. This, you come along, 15 years into your mortgage, and you're like, okay, you know what, my house needs to be renovated or something, whatever it is, and you want to borrow against that equity of the home that you have built in those 50 years.
Yeah, then you can set it up on your renewal even, and set up a HELOC and to say, So you're adding to, again, you're going to pay that interest.
You got to pay more off now, right?
Yes, you got to pay more off.
Yeah. So
it's good if you're about to sell and you want to do that. You just want to up a few things and you're going to get your money back out of it quickly. It's just you don't want something there long-term drawing, because if you're paying 7% off that money for several years, then it's not just a $30,000 reno. It's not like a $50,000 reno.
Because of the interest rate that you're paying.
Yeah.
So this is why it becomes really important to have a financial planner, and in these, wherever you're getting your mortgage from, to have a mortgage specialist that you're talking to when you're doing this, because it's a big part of your life. Honestly.
Yeah. So just, it's an exciting step. Just understand your financial situation.
Yeah.
Explore your options.
Yeah.
Compare lenders. Get pre-approved.
Yeah.
Okay, you can get pre-approved on some mortgages and what you can afford. Talk to someone. Factor in all the costs, because you'll have closing costs, all that stuff.
Yeah.
Lawyers, plus you'll need insurance. And
we've talked about that before, right?
Yeah.
Podcast that we did on life insurance.
Yeah.
Mortgages. You have to have mortgage insurance, which is kind of like life insurance. Mortgage insurance.
They want you need the property insurance. So work with a mortgage professional.
Yeah.
It's just make sure you understand those factors and what's happening, and then it just
Now the other thing is, people who are just starting out and buying their first home, some have a really good down payment. Maybe bank of mom and dad, whatever the case may be.
So first-time home buyers, you're allowed 5% down, but 5% off $1 million mortgage.
Mortgage is a massive monthly payment.
So 5% is good, but you gotta say how much can you afford, right? So
you can still get a mortgage with just 5% down.
Well, if it's a first-time home buyers, you
can.
If you want to get rid of the CMHC, which is that you put in 20% down. So, if you can put 20% down, put 20%. The more you put down, the better.
Better it is.
But it's just going to help you lower your mortgage, and again, help lower your payment, and you do a longer amortization, then you can maybe put that in your budget. But again, it's hard to come up with. They do have that first-time home buyers account that you can start investing in. You can put up to $40,000 in, so you can plan for that. So that you start putting down a payment.
So basically, the lowest is 5%, right? You have to have at least 5% for the first-time home buyer. I don't know about the second-time home buyer, but the first time for sure you have to have 5%. But it can go up to 20, 25, 30%.
Well, you can put whatever you want down.
Right?
So you're putting 20% down off a $1 million home. It's $200,000.
Now, what's this? You mentioned something that some people might know, might not. CMHC. What is that?
That's
Canada Mortgage?
Something.
The multiple choice here, Paul. Okay.
Yes, if you're below a certain percentage, then you're going to have to get insurance on that. So it's to cover that. It's to cover the below the 20% mark. So that's what the cutoff is.
That's a law, right? Like 20%. If you put like 15% down, 10% down, you have to go through CMHC, and they have to approve things as well.
Yes. So you'll have to, most first-time home buyers do it. But yes, you have to. You got to make sure they're going to cover it, right?
Yeah,
So,
yeah. Yeah, because CMHC has to approve it as well. Is that what it is?
yeah.
You
So
have to sign
you
off
know,
on it. Yeah.
it's yeah, they'll have to sign off on it. So it's
Yeah.
Canada Mortgage and Housing Corp. So
Yeah,
just
yeah.
making sure that that's covered. So
I see. Okay. So basically, we've covered today different types of mortgages. We've covered a fixed rate mortgage. The interest rate remains the same for the entire term, and stability in monthly payments. People who like stability in their life. Then we've covered variable rate mortgage. Interest fluctuates depending on the interest rate that the lender is giving you. Lender being the bank or credit union or what have you, and so it can fluctuate. Payments may stay the same, but portions going toward principal versus interest can change. Some people think that the interest rates might be going down, so they might get a variable rate mortgage.
Yeah.
And when it they think it's hit rock bottom, and then they'll lock it in, make it a fixed rate mortgage.
yeah,
Right? So both of these mortgages, you can make extra payments at the end of the year. A little bit extra. You have to see the terms of your mortgage and see what it allows you to make those extra payments. Then we have open mortgage and closed mortgage.
so
Right?
lots of variables. Just check your options. Like this is where you understand your financial situation.
Yeah.
Explore your options. This is when you meet with someone, and if you're renewing, try to do it sooner because most places will let you within 6 months kind of renew, like to get stuff going, right? You want to within 6 months start looking at your options. You don't want to wait 2 weeks before and then start scrambling, right? So know when your mortgage is going to be due. Sit down with someone.
Yeah.
Do some research on your own if you want. It could be just as easy as a flip. Saying I just want to renew, and they'll do it for you. If you're with Scotia or Royal, whatever.
Yeah. But Paul, here's the
And
other
sometimes
thing.
they'll reach out to you. They'll know, and because they'll want your business again. Cause
Of course.
once it's up for renewal, you can go anywhere, right?
But this is what I was going to say, Paul. Other banks may want your business, so I can.
You can negotiate
I can leave or negotiate a better rate, or I can leave and go to another bank as well.
to say, you can just say I'm with Royal right now, or this is what I'm paying. What can you guys offer? Because sometimes they'll throw in other things too, right?
Like a toaster?
Possibly. Gardening gloves? I
Garden
don't know.
gloves, yes.
So, or they'll just, you bring your RSP over or stuff like that.
They
they'll
want
like to bundle
all of
stuff.
your business to give you the best rate. They want all of your business.
Right, so they may bundle. So,
Yeah.
it's just, look around. If you're renewing, try to get that done a little bit earlier. Before.
Let's say your renewal date. Your mortgage is coming up for renewal in 6 months. Why not start looking around and talk to other banks? Name of the game here is save yourself money, right? You don't want banks making money off you. Save yourself money. Shop around. There's a lot of places you can get mortgages from. A lot of banks.
Yeah, a lot of places.
A lot of credit unions, etc. Hey Paul, what about? Is there people known as like mortgage brokers or something? They'll do all that shopping for you.
Yeah. Or
So how does that work?
So if you have a broker, what they'll do is they have access to like so many different places.
Right.
So they'll pick out the best rate for you. So, but they, you're paying the broker as well, but they get a better deal, the broker, than you would. So they'll do all the work for you.
Yeah. So I don't have to go bank to bank to bank.
No.
to bank,
So the
then.
broker here goes, okay, Scotia's got this right now.
Yeah.
This is the best this is what we would recommend. This is the best deal because they can do all that. So a broker's good if you sit with someone. They're quite quick, so you gotta slow them down sometimes just to understand them.
Yeah.
But they'll do all the research. Really, that's what a broker does, and they'll get the best rate and what you want. So if you're doing fixed or variable, they'll do that.
A mortgage broker is a mortgage specialist, right?
Yeah, basically,
yeah.
they're just
But
they know.
they save you a lot of leg. They just fill out your application.
They have their own lawyers normally
Yeah.
to sign
Everything
off
in
on
one
stuff.
spot.
One spot. They'll do a lot of work for you, but you pay for that, which is fine. That's
Yeah.
part of the
Because you know what, when you
because
get-
they'll lower the rates
Yeah.
normally than
Yeah.
what you could probably get, so
Yeah.
it all works out.
They'll find the best rate for you, best product for you. Is that's
Right,
what
is what you
right? Yeah.
gain to what what you're looking for.
Right. Yeah, because otherwise it is a bit of a run around. You can be running around different banks. Then you have to have your lawyer closing this, that. Find a lawyer. Most people don't know a lawyer. So these mortgage brokers would have a lawyer. I'm not sure how banks recommend lawyers. I don't know if they're allowed to or not, but.
Well, they'll have. Well, you can have your own lawyer.
Yeah,
When
then you
I
have
did
to
my
find
first,
one.
I had a separate lawyer than my bank. But
You can Google anything nowadays as well, right? So if you need a mortgage lawyer, you Google and 10 will show up in the area. But you have to have a lawyer to be able to close mortgages, to be able to sign off and on the papers on your home deal, on the purchase and closing of a sale of a home.
And just in the end here, just understand what you're signing, what you're allowed to do, and keep that on file somewhere.
That's the other thing. Sometimes people lose their documents, and
and a lot of it's online now. Like I did one with a broker. It's all online. It's emailed, and it's all especially when it's through COVID. A lot of it's virtual now. A lot of people are virtual. But just keep those somewhere safe that you have.
Yeah. So
access
again,
to.
whoever you choose to go with, whether it's a bank or a credit union on its own, where maybe let's say you do all your banking right now at TD Bank, and you're familiar with the staff, and sometimes that's how people do it. They just go in and say, "Hey, look, I'm looking for a mortgage." They already have all your business. They have all your information, so it's fairly easy. Right, so or you can go to a mortgage broker who'll take all your information down and try and get you the best rate that's out there. So if saving money is important to you, you may want to do that. So that's what it is. I hope we've shed some light on different types of mortgage products that are available in Canada and what might be more suitable for your family and finances. If you have any questions, please leave the questions in the comments and we will answer them back. Please like, subscribe, share, and turn on your notifications. It's free, it doesn't cost you anything, and it helps us with our algorithms. Thank you very much for watching, and we'll see you next week.